As a key ingredient for economic growth, electricity has always been under regulatory watch. Today, it's one of the 104 goods that have been notified by the central government for the purpose of commodity derivatives. As a non-agricultural commodity, electricity falls into the category of energy, which also includes commodities such as natural gas, coal, crude oil, etc. As we all know, electricity is a unique commodity. It can't be stored easily and it must be balanced in real time. Historically, it has been traded through physical contracts, often with long-term bilateral agreements and spot exchanges. Let me come to the role of SEBI and CERC in making this happen. The lack of forward price signals has been a structural gap in India's power market evolution. Globally, electricity derivative markets are well established. In regions like the EU and the USA, they support deeper competition, better investment signals, and efficient price discovery. Therefore, the Ministry of Power and both regulators, SEBI and CERC, have worked together to facilitate electricity derivatives in India. First, the delineation of respective roles: SEBI to regulate financial derivatives on commodity exchanges, while CERC to oversee physical delivery-based contracts on power exchanges. A joint working group was set up between SEBI and CERC to work out the modalities for introduction of electricity derivatives. As we all know, CERC has been the architect of India's competitive power market. From defining the market design and enabling short-term trading to promoting power exchanges, its regulatory framework has fostered transparency, liquidity, and market integrity. SEBI and CERC have followed a robust, consultative, and data-driven approach to design the contract specifications and risk management norms to ensure that electricity derivatives remain tools for hedging rather than undue speculation. The primary participants in this market are power generators, distribution companies, that's DISCOMs, the power exchanges, and consumers and traders. These participants have faced persistent challenges. For example, price volatility in spot markets due to demand-supply dynamics, financial stress on DISCOMs which are locked into inflexible long-term power purchase agreements, lack of hedging tools to plan future procurement, and uncertainty that discourages investment in power generation infrastructure and renewable energy. Electricity derivatives, starting with monthly futures, will provide market participants a transparent and regulated platform to hedge against price volatility. These contracts will complement physical power trading by adding a layer of financial flexibility. Electricity derivatives will help participants plan more effectively by managing price uncertainty, mitigate revenue risks, and attract investments in the power sector. Specifically, market participants may be enabled in various ways. For example, power generators may now be able to lock in the selling price of their future output and ensuring stable cash flows even if spot prices fall due to any unexpected demand or supply changes. This stability is important for power generators to continue to expand their infrastructure to meet India's growing power demands.
If you like the video, do like, comment, share and subscribe.